Welcome to the September 2023 monthly MOTR Checkup. My name is Dave Lundgren, and I am the Chief Market Strategist and Portfolio Manager here at MOTR Capital Management and Research. The title of this month's video is Not as Much of a Tug-of-War as It Seems, and the theme is in keeping with the disconnect that appears to be going on between an increasingly more and more bearish or negative macro environment relative to what the stock market appears to be saying with respect to that those bearish data points. Therein lying this apparent disconnect, and I want to address that because I would make the case that there is not nearly as much of a disconnect between what the market is saying and these macro data points. So on the surface, it would seem that there is a growing tension between this macro data and, of course, the opinions with respect to that data and what the stock market is doing. The macro trends seem to be overwhelmingly bearish and more negative, while the market seems to be ignoring all of those negative messages coming from the economy. And while there is definitely some tension between the two, I would make the case, and I will make the case in this month's video, that it's not nearly as extreme as most would argue. Indeed, there is actually, I would say, there's actually more agreement than disagreement. So at the end of the day, it's not the current macro data that matters, nor certainly is it our opinion of it that matters, but it's more what the market thinks. And what the market's opinion is obviously manifest vis-a-vis price trends, and those price trends reflect what the market perceives to be on the horizon relative to the economy. And let's not forget that the S&P 500 is in the index of leading economic indicators for a reason. So we want to be mindful that what matters more is the trends in the market as opposed to our opinions and views on the current macro data. So currently, while it's not crystal clear and it's not clearly bullish, and I'll give you some examples of what a bull market looks like so that we can kind of like level set what we should be looking for if this were indeed a bull market. So we can say that it's not a bull market, but it's also, I would say, not bearish. And I'll show some data to support that. So, at any given moment, the market can either go up, down, or sideways. And that's a rather quaint notion, but it's true. And I believe that if the down scenario is off the table, that means that we're left to invest for either sideways to up. And frankly, the worst case scenario of those two is sideways. And that scenario is not a headwind to stock selection. So we should not be positioned defensively or raising cash or anything like that. We should be really focused on stock selection with the expectation that in time, the market will inflect to a more bullish environment, which will then lead to the market being a tailwind to our stock selection. But until such time, I just don't think it's a headwind either. Short-term pullbacks aside, of course. So currently, sector leadership remains cyclical. It has been all year, even into the as far back as the fourth quarter of last year. It is rotational. We've talked about this quite a bit. More recently, energy has gained the number 2 spot as industrials, which have been number 1 for many months, are just taking a pause. And then for those that are more globally oriented in their exposure, India and Japan are also leadership. So you should take a look there for ideas. I've already featured India in one of our MOTR spotlights a week or so ago. So take a look at that for your if you're a global manager. Look in your email for that. If you can't find it, please reach out to me and I'll be happy to send you another copy of it. So let's take a look at the market in what I would say that it's actually done since the beginning of the year relative to what we might perceive it as doing versus relative to what the NASDAQ and the S&P are saying. And much of this is already known, but I think it's really important to connect the dots between what the market's doing on average and what these economic data points that everybody's pointing at that are so negative and sort of casting a pall upon the market. And the phrase that I've heard is that the market is kind of whistling past this graveyard and just completely ignoring all this macro data. And I just don't believe the market's ignoring the data. I think if you dig beneath the surface, you will find and you will see that the long-term trends, the majority of the trends are negative. And there are pockets of the market that are doing well. There are pockets of the market that are doing poorly. But at the end of the day, if you've been doing this for long enough, you know what a bull market looks like, and this ain't it. And so I just want to kind of cover that real quickly here. But outside of those 9 stocks that I've referred to in the past as the MOTR Management Index, which you can see the constituents are down here. This is just an acronym for these 9 names. Outside of those 9 names, and of course other areas of the market as well, but predominantly most stocks are still in a bear market. And when you look at the value line geometric average, and I think it's important to look at this average because this is the pond in which all investment styles are fishing to fill their portfolios. So this index that you see here is not biased by any one of the various styles that folks fish in this pond for. So it's not biased or driven by market cap or growth or value or anything like that. It's just, this is what the average stock is doing. We all fish in this pond and we all try to outperform what we see here. And when you look at this picture, you see that there's actually not a lot going on. So this may be why, this clearly explains why a lot of strategists and strategies are not doing so well relative to that small pocket of very large cap names that are doing well year to date. But nonetheless, when you look at this index, this pond that we all fish in, it's still down 20% from its peak when the bear market started. And beyond that, it's still down roughly 8% from the August peak and the January peak of this year. So there's like, if you've been doing this for a while, you know that this is just not, this is not a bull market. You need the preponderance of evidence to support that capital is broadly flowing into the stock market, and that's just not the case. So to the extent that folks are scratching their heads saying that the market is completely ignoring the overall negative or dire macro environment, it's clearly not. We're still down 20% from the peak. And then when you look at year to date, the market's only, the average stock is only up 3.5% year to date. This is just not a bull market. So this is not reflective of a bullish outlook as vis-a-vis the trends in the stock market. I would say that the market, as depicted by trend, is almost perfectly aligned with what we're seeing on the macro front. So I don't see a disconnect here. And if you need to see this in a little bit more stark contrast here in terms of what people are perceiving to be the case versus what's actually happening, the market has literally been sideways for more than a year, almost 18 months. So with the exception of a few forays outside of this box, we've been inside this box for almost 18 months. So there is no bull market here. The market is not whistling past anything. The market's going nowhere, and it's still down 20% from its peak. So if you ask me, the market's very much reflective of what the macro environment is painting. So when you look at this environment vis-a-vis our trend setup grid, which you'll hopefully be getting more and more familiar with this as you notice them being featured from time over time in our weekly motor reports and our charting my interruptions and the various other spotlights and things that we're doing. What we're doing is we have 2,600 stocks in the US, and we're just breaking them down by trend structure, positive trends and negative trends. And stocks that are, for instance, that have positive trend structure are doing one of two things in that context. They're either trending, in other words, making progress in that uptrend in various degrees of extension, or of being extended from the point of breakout, or they're just basing in the context of an ongoing bull market or uptrend. And you can obviously paint that same picture for the downside as well. So having these basically 16 labels, and every stock falls into one of these labels, we can now say, okay, well, where is everything? Where are the majority of stocks? And beyond that, we can also do this analysis across 3 timeframes. And you notice long-term, medium-term, and short-term. And I always want to point out, just as a reminder, that when I say short-term, just remember that my short term is the weekly chart. So most technicians, when you ask them what's their what's their long-term chart, what's the long-term perspective, most will take a look at the 5-year weekly chart, which is fine. That's actually a good place to start to get a long-term view. In my analysis, that's my short-term chart. So we're looking at weekly charts, monthly charts, and quarterly charts. So these out here, as per what Charles Dow would say over 100 years ago, these are driven by fundamentals. So the ability to take 2,600 stocks and bucket them across these different buckets of trend structure across multiple timeframes, we get a pretty good sense of what's going on from the bottom up based on trend. And when we do that, what we find is that we can now see why we can feel that tension because there's just an awful lot of ambiguity across the different timeframes of trend. In the very long term, 56% of the market is still in a downtrend. In the intermediate term time frame, which is that monthly chart, which again is a very significant chart, over half the market's in an uptrend. And then you kind of drill down a little bit further, you get into the weekly time frame, and now you're back to the majority in a downtrend again. So this conflict of time frames in terms of price trend is the reason you feel, or we feel, this tension in the market, because there is tension. There is nothing about this that says bull market. And again, I'll show you what a bull market looks like in a moment. But this is perfectly reflective of the macro environment. And so I don't really see them being much of a disconnect. The good news is that in the case of these longer term timeframes, this monthly and quarterly chart, the good news is that although in particular in the long term time frame, there's the majority of the charts have negative trend structure. Nonetheless, the bulk of that negative trend structure are actually bases. And so that's the good news. So much of the damage that was inflicted upon the market last year, in last year's bear market, is still hangs over the market in the sense that most downtrends are still in place. But within that context, most of them are bases. So these blue boxes represent the biggest bucket in each of the timeframes. And you can see that the biggest bucket is a downtrend correction, possible bottom. So these are large bases in the context of an ongoing sort of bottoming process. And I think that's worth noting, because if we, like last year, the biggest buckets were all down here in downtrends that were well underway and making new lows and continuing to inflict damage upon the market. And so right now what we're seeing instead is the majority of these quote unquote downtrends are actually basing. And to the extent that we've seen any damage, it's all been confined to just the short term. So as we know, the market kind of, from a breadth perspective, peaked back in July. And this was, again, not something to be surprised by. I mean, we kind of highlighted ahead of time before we even got there that 45 to 4,700 is where we should start to see problems. We should start to see a pullback in the market. That would be perfectly natural for that to happen. What was more important was that as the short-term trend structure began to deteriorate, and we can see that that's taken place since then, with now 65% of the market in a downtrend. What was more important than that was, could this take place without doing any damage to this improvement that's taken place in the longer term and medium term charts? And so far, as we can see, that has been the case. There has been no or very little damage being done to the progress that's been made in these monthly charts and in this basing structure in the quarterly chart. So we've been able to get through this downtrend, if you will, on these weekly charts without doing any damage to these trends in basing structure that really kind of hold the key to the future here. If we can get through this corrective period without doing damage here, that sets the stage for a resumption of this basing process and hopefully new highs into the new year. And of course, we know this, but when you look at this analysis from a market cap weighted perspective, we know this to be true. But the majority of charts in this quarterly time frame are already in an uptrend, and the degree of positive trend structure in the monthly time frame is significantly better. And even in the short term, the damage has not been nearly as bad. So when I look at this chart, this table, I don't see a bull market, but I also don't see a bear market. So that leaves us with sideways to up. And if that's the case, then we want to be really focused on stock selection and just waiting for the time in the future at some point when the market becomes a tailwind to our stock selection efforts. So I've been sort of all over this as well, but I want to reiterate it once again and also highlight the rotational aspect of it. But importantly, if you were bearish, or you in conversation with somebody that was bearish, and you said, okay, look at if you wanted to see a bullish setup, what would it look like from a leadership perspective? If you're bearish, what would it take to get you to be bullish from a leadership perspective? I think most people, even bearish people, would say, well, I would want to see some combination of technology and energy, industrials, discretionary materials, and financials in leadership. Well, that's what's leading. So again, if we believe that the market's very good at looking forward and discounting future economic trends, if that's true, and if you philosophically believe that, which obviously I do, why would this be the leadership if the market didn't like what it saw down the road? So I think this is an important point. It is rotational, energy has moved up to number 2, and we'll talk about more about that in a moment. But it's also worth pointing out that financials, which are really have that anchor around their neck of banks, which have just remain sort of in a quagmire. Even despite that, financials are number 6. So I don't know. We've thrown a lot at this market. Three large bank failures, a debt downgrade, a war, all these other things. A lot of angst about the upcoming election. Now we have impeachment discussions and all these other things, and all of this is weighing on the market. And yet this is the leadership, and yet we're not breaking long-term trends. So I don't know. I just think the market's absorbing a lot, and once we can get through this period of digestion, we're just setting the stage to move higher again. And ultimately, you remember the risk gauge, which measures price trend, relative trend, momentum, breadth, and volatility across 3 meaningful timeframes, as I indicated, weekly, monthly, and quarterly. Given this sort of quagmire of trends and sort of overlapping and conflicted, I guess, development in those different timeframes, what we find is that the risk gauges themselves are somewhat mixed, which is exactly where they should be. But what's important is that they're not negative. And I just want to stress that's the most important thing. As I mentioned the other day in one of my notes, oftentimes what's not happening is just as important as what is happening. And the fact that we've got all of this pressure weighing on the market and it's not breaking down, I think is extremely important. The daily time frame, which is where all the pressure is being felt, has downticked to 7, but it has not gone into risk off, which is very important. And then ultimately, even more recently, the medium term and long term have actually both ticked up again. They've been kind of oscillating back and forth between 4 and 5 in the case of the medium term, and between 6 and 7 in the case of the long term. But more recently, they've ticked up again. And all the while that's been happening, we are now back to oversold in terms of breadth. So this is showing 40% of the 2,600 stocks in the breakaway, in the motor research universe. 40% of them are above their 15-day average. 32% are above the 50-day average. So that's oversold breadth in an environment where we've done no damage. So that's an oversold base at worst, possibly the beginnings of an oversold uptrend. We'll see. But we currently have 47% of the market is above the 200-day average. So this is more of a trend indicator. These are more momentum. So they're green when they're oversold. This below 50% is actually more of a trend indicator. So it turns red below 50. But again, as I said in prior notes, we really want to see this hold above 40. We don't want to see this break below 40. And then we still have 51% of the 200-day moving averages are still rising. So all of this taken together is just not bearish. And so it's sideways at worst. Leadership is very strong, and I think it's just a matter of time before the market stabilizes and we begin to move higher again. So as we're waiting for that, I just want to once again reiterate the key resistance and support levels that exist in the market, which again, it may be a little bit of annoying that I keep highlighting these levels, but that is the point. The fact that these levels have not broken in either direction is the point. Resistance is 45 to 4,700. Failing here, it should not surprise anybody. This is exactly where we're supposed to fail. So failing here should not be a surprise. Support remains true in the 42 to 4,300 area, which is a level that we first many months ago highlighted as resistance. We've since taken it out. Resistance, once broken, becomes support. So here we are. And what's important about this is that if we get a pullback to here, we should not be surprised by it. But what we should anticipate is that it holds, and that in time we move higher. And then as time goes on, again, I've highlighted this support zone for quite a while now, but it's been with us for so long that the 200-day average has been slowly rising, and it's now beginning to enter that support zone, and that's just going to fortify the support zone. So it's just going to be another trend element that is now in that area that should support any price weakness into the 42 to 4,300 area. So the temptation will be to get more and more bearish as we get into that zone, but I would just advocate for keeping you cool and rather than looking for things to sell in short, instead, looking to rotate into leadership and using that pullback as an opportunity to better position your portfolio for the resumption of the uptrend. So this is something that I, again, never wanted to be complacent about the data just because it's currently constructive. We always want to be on the lookout for things and messaging that might be early tells that something might be brewing that might later affect the market negatively. And so this is just one of the many intermarket relationships that we monitor. This is copper to gold in this black line. So it's just a ratio between the price of copper and gold. And obviously, copper outperforming gold is a pro-cyclical indication. So when copper is outperforming gold, generally speaking, we see the stock market going up. So these green boxes highlight the areas where the black line is rising, and you can see they generally coincide with strong stock market environments. So this is a data point that we see featured many times in conversation with respect to how the market's disconnected with the economic environment. So you can see that here, the market appears to be completely ignoring the fact that the copper to gold ratio is not moving higher. And of course, the alarm is that this is not the first time this has happened. And of course, the last time this did happen, the market was rolling over already heading into COVID. So before COVID even began, the copper to gold ratio was already giving us a warning. And it looked like the market was ignoring it. But I'll point out in a moment that it's not necessarily as disconnected as it seems. As I've already indicated, the average stock is not nearly as strong as what the S&P is indicating, and it's not nearly as strong as it looks today, nor was it nearly as strong back here. So if we overlaid onto this chart and replace the S&P 500 with the value line geometric average, we get a very interesting difference in the market's interpretation of the essentially collapsing copper to gold ratio. We see them very much aligned once again. And importantly, we also see them very much aligned the last time there appeared to be a disconnect. My point being that there was no disconnect. These two things were aligned back then, and they're aligned right now. So we want to be mindful of this because this is something that we want to see change. It's not likely that we're going to get a robust bull market unless we see copper beginning to outperform gold. So, we can see that there's a bit of a higher low here. That's a potentially good sign, but nonetheless, we're going to want to see this get better before we really embrace the idea of a bull market. But as I've said earlier, I've already said that this is not a bull market. There are many charts that I'm going to show you that indicate that this is just simply not a bull market. And this is one of them. Other things that I've shown you also demonstrate that it's also not a bear market, which leaves us sideways as our worst case scenario. But to really get the bull market ignited, we're going to want to see this copper to gold ratio turn higher. So one of the things I want to really harp on, and I've mentioned this several times in other notes and perhaps other videos as well, but during bear markets, it's your first priority is to make sure that you've positioned your portfolio for the bear market. Once you've locked that all down and do whatever you need to do within your mandate to position your portfolio for a bear market, the next thing to look for is what's actually outperforming or performing better than it should be performing, despite the fact that we're in a bear market. So there are many examples of this, but like in 2000, after the technology bubble peaked, in the throes of a bear market, when everything cyclical should have been plummeting, oddly enough, home builders and energy outperformed. So when the market finally bottomed in 2002 and 2003, those were the two leadership sectors once the market finally bottomed: energy and home builders. And then again, when we had the global financial crisis, in the throes of the financial crisis, when the consumer discretionary sector should have been imploding, given that everybody was in unemployment lines and layoffs and bank runs and everything else, why on earth would the consumer discretionary sector be outperforming? But it was. And also, why would the biotech space, which is the most, that's the part of the market that requires the most optimistic outlook that you can potentially conceive, because biotech investing is all about the future. There is no present, and so it requires a very optimistic outlook. And yet, during the global financial crisis, in the throes of Armageddon and on the brink of what would appear to be at the time the oncoming of the worst depression since the 1930s, despite all of that, the biotech industry was outperforming. It was going down with everything, but it was outperforming. And when the market finally bottomed, guess what the two leadership sectors were? consumer discretionary, and biotech. So all of that is to say that during a bear market, what's outperforming when it really shouldn't be is oftentimes the market's way of telling you what future leadership will look like. And so when we look at these are the sector performances since the beginning of the bear market, all anchored to zero here. And what we can see is the RSP, which is the equally weighted S&P 500, which has done a little bit better than the geometric average, which has 1,700 stocks in it, and it's got small caps and things like that in it. So the larger cap equally weighted index has done a bit better, but it's still down 7% from early 2022. And technology, discretionary, financials, media, and real estate, they're all down double digits still. So once again, this is a bear market. It's not over yet. I think the lows are in, but the churning and the conflicted trends and the trying to decide what future leadership is and all of that is still ongoing. And I think we feel it. We can see it now, hopefully, in the data that I'm showing you. But while all of that is going on, energy says, "Look at me." Not only is it outperforming, it's up 68% since the beginning of the bear market, and it's essentially breaking out of this very large base. So while we're in the throes of this bear market, leadership is clearly coming from energy. And so I think energy needs to be really a sector that portfolio managers have on their radar to be overweight if they're not already. We're overweight in our portfolios. So this is the clear, obvious, look at me moment for future leadership in the next bull market. And it's worth noting too that this purple box down here is the equally weighted industrials, which have been really lighting it up on a relative perspective since the very beginning of the bear market. As I mentioned in prior videos, that pretty much on the day that the stock market peaked in January of 2022, relative performance on industrials bottomed, and industrials outperformed all the way through the bear market. So between industrials and energy, it seems relatively clear to me that we want to be overweight those two areas because during a bear market, they're leading today. So just drilling down a little bit further on oil and what it means for the energy sector leadership. Again, despite the strength in the dollar, I covered that last month. I showed you the trend setup grid for the dollar, and it's basically trending against virtually everything. I think it's something at this point, it's in the 80s to 90% of 35 or so crosses that I monitor. The dollar is trending positively against the vast majority of them. And so typically when you see a strong dollar, you see weak crude oil. And so for whatever reason, we'll find out why later, right now we have a disconnect between those two. And so it's interesting to note that despite the strong dollar, crude oil has broken through this 85 resistance area that I've highlighted in prior notes. And what I was indicating at the time was that we should already be exposed to energy as a sector in our portfolios. But if we close above 85, we really need to consider being overweight the sector, in which we are now in our portfolios. So we can see here with this break above 85, we now have a turn higher in momentum, which, looking at past examples of it, it tends to be a pretty good indication of at least a temporary move higher. For now, I don't think we need to get too heroic in our outlook. 100 to 110 on oil is to me is the most likely area that we're going. We don't have to even start entertaining this notion of new highs. That's not really what's important. What's more important is the inflection and the direction of oil at this point. And that's pretty evident when you look at when you overlay the energy sector on top of oil, and you can see that energy kind of, no surprise, moves in the same direction as oil. So from this perspective, what really matters is that if we're going to 100 to 110, oil already began outperforming, before energy began outperforming the market before oil actually turned up. So I guess now we're discovering later, why energy's been outperforming for several months, and that was the market's way of looking forward in anticipating higher crude oil prices. So here we go again, another example of the market looking into the future and kind of assessing the economic trends better than most individuals, certainly in aggregate. So here's a look at the energy trend setup grid. So if you're wondering what a bull market looks like, here you go. This is what a bull market looks like. So eventually, it is my belief that in 2024, this is what the broader market will look like. But for now, the energy space looks like this. So the long-term trend structure in this risk gauge is still a 1. So remember, this has been up here in this risk on area for it absorbed all the weakness that took place in these two timeframes of the risk gauge over the past 18 months. obviously have recovered and now are back into risk on again. The fact that this didn't budge from risk on, once again, underscores the long-term nature, the fundamentally driven long-term nature of this trend inflection that took place over the past couple of years. And so this is what a bull market looks like. Most of the trends are uptrend, not extended from breakouts. So this is really kind of just getting going. We're getting confirmation from both breadth, where the average stock is, as well as where the market cap is within the sector. So again, this is a sector that's leading, and if you're not overweight yet, I think you should seriously take a look at being overweight this sector. Okay, so just giving you two examples of what a broad market looks like when it is in a bull market. This is India. I featured a note on this a couple of weeks ago in one of our motor spotlights. So once again, if you can't find it in your email, please reach out to me. I'd be happy to send it to you. But this is what a bull market looks like. In fact, this one's pretty extended. You can see that the short term and medium term are in risk on. This is hovering just below risk on. You can see the leadership here in India: industrials, tech, financials, and healthcare. Lot of very extended trends here. So perhaps not timely at this point, but for global managers, any weakness that we do see here in the fourth quarter, this is an area where I think you should be looking for ideas from a global positioning perspective. And then the same thing with Japan. Japan, we're looking at 420 stocks here. Also very extended risk on in the long term. Utilities, for whatever reason, they're in the number one spot. I mean, looking at some of these charts, if I didn't know they were utilities, I think they were tech stocks or healthcare or biotech or something. I mean, they're going vertical. I'm sure obviously there's a fundamental reason driving that movement, but financials, inflation sensitive, economically sensitive energy. This is your leadership within Japan. So again, I haven't done a spotlight on this, but I plan to do it soon. But if in the interim you're looking for ideas, please feel free to reach out to me. But just to conclude, this is what a bull market looks like. And I do believe that in time, this is what the US will look like at some point in the early part of 2024, if not sooner. Okay, so just in summary, the market's opinion of the macro landscape is not nearly as disconnected with the macro landscape as macro strategists and news outlets would have us believe. The market actually, if you kind of consider what I just showed you from a chart perspective, is actually rather reserved in its outlook. It's not necessarily as robust and optimistic as most strategists would have you believe. Importantly, though, and this is from a portfolio management perspective and from a risk management perspective and a stock selection perspective, what's actually more important is that the conditions are not bearish. And what I've mentioned several times in prior notes is that if you can eliminate bearish, then you're just left with sideways to up. And so neither one of those is a reason to be negatively or bearishly positioned. So you have to just keep this in context so that if we do get further weakness from here, maybe down to 42 to 4,300, the context is still bullish. So don't use that as a reason to get defensive and bearish. If anything, use that as an opportunity to reconfigure your portfolio and get positioned in some of these areas that are leading currently. I just think, given what's happening in this bear market environment, it's difficult to ignore the strength of the energy sector. And so it's been leading not just recently, but also since the beginning of the bear market. So this is durable, I would say, structural, secular leadership change going on here. I think it's in the throes of a bear market. Energy is leading. I think we need to pay attention to that. And just as important, it's also difficult to ignore the fact that oil is as strong as it is despite the strong dollar. So all of that being said, we remain overweight cyclicals. We remain overweight energy. Global portfolio managers that are looking for allocations outside the U.S. The three best areas are actually India, Japan, and also Latin America, all of which we'll be featuring and focusing on in future spotlights. But that's what I've got for you in this month's video. As always, my contact information is here. Please reach out to me if there's anything that I can do to help with reviewing portfolios, watch lists, etc. And good luck in the coming month, and thanks for listening.